numbers to you. Okay, so what you have over here on the right hand side are your buyers, and what you have on the left hand side are your sellers. There's only two things, okay, you can do in the market. Either you can be a buyer or you can be a seller in the market, right? So on the right hand side you'll find all the buyers. If you entered buy side trades, okay, you would get these buyers over here, and on the left hand side, okay, you would find all the sellers of the market. And you can easily see it, okay, by all this red font, and you can see it, okay, by the green font, okay, which is here. The green font, okay, will tell you, okay, that there are buyers in the market, and the red font, okay, will tell you, okay, that there are sellers in the market. It's a very simple mechanism. We have not complicated it. I know some of you, okay, use order flow charts, okay, and then, okay, you see that there is a lot of, okay, complexity, okay, when it comes, okay, to showing, okay, this data out over there. But switch off music. Fine, let's do that. Okay, sorry about that. I completely forgot about it. Is it done now? Am I visible? Audio is fine now. Background is gone. All good? Okay, perfect. All right. So I have a bank Nifty, okay, chart on screen. All right, we'll okay, put up a Nifty chart also, and we can put up an option chart also. Okay, I'll try to explain it to you. I know some of you are used to seeing a Nifty chart, bank Nifty chart, but it's the same information. Okay, and the information is on the right hand side. Wherever, okay, you see green font, you're gonna see buyers, and wherever, okay, you see the red font, okay, you're gonna see sellers. Now there is a little bit of complexity about that in the market today, and some trading programs, okay, will tell you, okay, that the buyer is on the left and the seller is on the right. But what you are in and the chart, okay, you're seeing is the chart, okay, from VTrender, and it simply means this, okay, the complexity is out. It simply means, okay, that the buyers are always, and I'll repeat that, always on the right hand side, and the sellers are always on the left hand side. And I'll try to make it as simple as possible. There is no complexity here at all. All the buyers every single time are going to be on the right hand side, and all the sellers every single time are going to be on the left hand side. Right now, what we do is we have a candle right next to, okay, this information chart. This is our candle, all the candles, okay, which we are used to. We have not taken the candlestick out. This candle, okay, is right here, okay, on the left, and this entire thing is one order flow bar, right? So the candle is here on the left, and the information which is there within the candle is on the right. And what information? The traded quantities of buyers and the traded quantities of sellers. That is that information over there. Right now, a lot of us, okay, when we first see an order flow chart, we focus, okay, on this candle. We focus, okay, on this color of this candle, and our minds are actually, okay, programmed, okay, to just look at what this color is. But this color, we have to, okay, just put it aside, okay, for some time, and try to understand, okay, why sometimes, okay, this color is red, and why sometimes, okay, this color is green, or what really happened, okay, between the high and the low over here. So what we're doing is in order flow is we are adding data to a chart. We are adding information to a chart, and we are trying to find out what happened, okay, between the high and the low of the bar, or what happened, okay, between the open and the close of the bar. Right now, the color of this candle is dependent on the open and the close, right? So if the close of the bar, this is the close, if the close of the bar is lower than the open, the color of the candle is red. Or if the close of the bar, of this particular bar, is higher than the open, the color of the candle is green. right? In order flow, what we do is like, okay, we don't pay attention, okay, to the information in the color of the candle. What we do is we try to find out, okay, what has happened, okay, between this buying and the selling. Now this candle has closed over here at 11:15. Why did it close over here? Because, okay, it met, okay, a little bit of serious buying over here, and that, okay, took it from the lows of 51,219 and placed it right here, okay, around this 51,275, 280 mark, right? The same thing over here. This color became red because there is a 314 lot seller which came in exactly at 51,412 and pushed this from the high to this close. So what you are seeing is you're actually getting a little bit more information than the open, high, low, and close of the bar. And you're seeing, okay, in this important points, okay, where the seller is operating and where the buyer is operating, allowing you to make more informed decisions about pricing, right? Now, like I said, it's not just about every single person trading out over there. That's not the purpose of an order flow chart. So I'm not going to be interested, okay, in this 16, 91, 70 and all the other random numbers over here. I'm interested to find out, okay, where the big trader is trading, where the big money is trading. So here I can see that this is a 2000 lot seller. There is a 710 buyer over here, right? And after he's entered, okay, there is some selling, okay, which has come, and again, okay, some buying has come in, right? Now this is, okay, something which is important to me. The 664, the 146, the big numbers. I am not interested, okay, in the 9 and the 48 and the 11 and the 33, right? So what I do is I train my eyes, okay, to look at, okay, where the big numbers are coming in, and not just, okay, about one big number coming in. It's about, okay, them coming in a sequence. It's them, okay, coming into a pattern and forming, okay, something very, so forming a pattern for us. So some of you requested a Nifty. The same information, okay, will be there on a Nifty chart also, and I'll go into a 30-minute version, right? So here, let's look at this Nifty chart, okay, from the start of today, right? So here, as the market, okay, was probing up to about 25,150 early in the morning, between 9:45 and 10:15 early in the morning, you can see, okay, that there is no green demand. There is absolutely no green demand. In fact, okay, the red is a lot more, okay, heavier, okay, than the right hand side, okay, which is green. So this market, okay, tells you, okay, that as it is going up, it is not meeting new demand, and as a result of that, the market, okay, has to go lower, right? But today's market, okay, is what we call a rotational market, and in a rotational market, okay, the buyer and the seller are equal, okay, and so, okay, they jostle with each other and they are moving each other. There's no, okay, strong player in the market. But contrast this with what we saw, okay, a few days back, right here, okay. Here you can see that there is a lot more significant, okay, buying which is coming in as the market, okay, dipped lower to 25,050 right here, right? So here, okay, you can see 2277, 2740, 1535, 288 in the Nifty, and against that, okay, there is no opposite seller who's got a similar strength. So what does price do? Price, okay, jumps up, okay, immediately. Now what does this tell you? This tells you that there is a lot of demand which is coming in, and when you see these kind of greens, okay, coming in, is this the time, okay, to enter a long put? Absolutely not, right? Because, okay, the market, okay, has got now a sea of buying coming in, buyers. The next day also a lot of buyers come in, and the market, okay, pushes lower. A lot of people, okay, who do not have this information, what they would do is that they will see, okay, that the market, okay, is going down, and in fact, okay, it did go a lot down that day. That day, this market was at 25,350, and it was meeting a lot of supply and going lower. It was at 25,350, meeting a lot of supply and going lower, and just at the lows of that day, at 25,050, a lot of covering happened, a lot of green happened. But if you didn't have this information that there is covering happening, you would say, okay, that the market is gone lower, and you would, okay, end up, okay, with a long put, thinking, okay, that the market, okay, can go down further. But there are points in time, okay, in the market, okay, where the seller initiates, the seller books profit, and because, okay, he books profit, there is no further supply in the market, okay, to take the market down further, right? And because of that, okay, if there is no supply, price has no incentive to continue down. Price has no incentive to continue down. So the market, okay, stages a recovery, and what we get is a classic short covering pattern. This is what we call a short covering pattern. You heard the term short covering before, but now with an order flow chart, you can see it practically live, working in a live market, such that, okay, there is no need of any kind of guesswork, right? So what you do is, like, if you had a put or a long put or a short call, okay, over here, and you saw these big people booking profits, now is the time, okay, for you, okay, to start booking profits also, right? The short was established right here. A strong short over here. This is, okay, one of those trades over here. Again, okay, at the highs 25,350, okay, again at the highs, okay, you're seeing, okay, that there is virtually little contest over here between the seller and the buyer. Right here, okay, as the market close up 1296, 1456 against 577, 105, 85, the seller is overwhelming the buyer in a factor of 10:1. And when that happens, you get up a 95% probability trade setup. Not the 50-50 ones. The 50-50 ones, okay, will keep coming in. This is one of those rare setups where initiative sellers, okay, come in and, okay, they take advantage, okay, of a market, okay, which is showing more supply, add more supply, and the result is that the market, okay, goes down, right? Now I can show you a lot of this evidence. Okay, a lot of these things, okay, have happened, okay, in this market, especially in the week gone by, because, okay, the market dropped, and the market dropped because supply was greater than demand. That is the only reason market drops. The market does not drop, okay, when demand is bigger than supply. When demand is bigger than supply, okay, the market, okay, has to go up, right? Now what we've done, I'll just zoom out and show you. What we've done is that we have made these charts a little bit easier for you to understand, in the sense, okay, you'll see, okay, that some of these candles are colored purple and green. Now these are candles, okay, which we call initiative selling candles, or IS candles, and there are candles, okay, which are covered in green, which we call initiative buying candles, right? What we essentially done is, through all this, I'll just zoom out, okay, so I can show you a cross section of what is happening. What we've done is, all through, we have shown okay, to you, okay, how, okay, you can take advantage of data which is flowing in, right? So this is, okay, that big selling, okay, which came in earlier last week, and you would see that, okay, this is a red bar over here, right? A red bar is an initiative selling candle. And what is an initiative selling candle right now? An initiative selling candle is simply a bunch of market orders coming in and entering the market at any single point. Okay, they are coming in and wanting, okay, to execute directly at the best available price in the market. And we pay a lot more attention, okay, to these candles, these IS candles, than, okay, a lot of those normal candles. When these candles come in, the market move is a lot more faster, right? Now what do you think about these IS candles and IB candles? When I was, okay, doing my order flow training, I was told that think of these initiative candles as somebody, okay, who's at the airport, who does not have a ticket, but goes, okay, to one of those counters, okay, like your Indigo counter or a Vistara counter, and tells them, okay, I'm willing to pay you the price, just get me a seat onto this flight, because I have to go from Pune to Delhi, and just give me a place anywhere, okay, I'm willing to pay whatever price it is. That is a market order for you. Now why does this person do it? Because, okay, he's got an agenda in Delhi. He wants to fly, okay, from Pune to Delhi for a conference, for some reason, for a family thing, for whatever, okay, he's doing it, but he's got an agenda, he's got a plan, right? The casual trader is not going to go and walk, okay, into Indigo, counter at the airport and say, okay, give me a ticket at whatever price. If he has a plan, okay, to go, okay, to Delhi, he'll book 25 days in advance, and then, okay, he's going to book. But the man in a hurry is going to pay, okay, whatever price, okay, is to be paid to get onto that seat. And that is the definition of a market order. They pay whatever price is needed to pay, because, okay, they realize, okay, that this market, okay, is short and wants to go down. So they are in a hurry, okay, to go down. And all these sellers, they entered, okay, around this 25,700. In fact, okay, they got a second chance to enter again at 25,700, and the market, okay, dropped 700 points lower to about 25,000 and even below. We are still trading at 25,000 because these sellers had taken advantage of the demand supply mat and built up, okay, positions for themselves, right? So whenever, okay, you see an IS candle, what we do is we pay attention to the high of the candle plus a filter, and 8 out of 10 times the high of the candle is not going to be violated, okay? And if you miss getting into this candle, your actionable point is, okay, you have to, okay, start selling below the low of that candle. So these guys, okay, who sold below the low of the candle will start selling with a stop loss above the high of the IS candle, and they have a trade set up for them. These guys who came in, they will start selling below the low of the candle with a high, okay, with a stop loss at the high of the candle, and, okay, they will, okay, trade for a move down. This is a simple setup. It gives you, okay, the advantage of taking information, okay, from people who are putting a lot of market orders and are in a hurry, okay, to run, okay, in the market and execute in the market, right? So this is, okay, what we call, okay, initiative selling patterns. And the opposite of an initiative selling pattern is an initiative buying pattern. So this initiative buying pattern will come, okay, when there is a lot more market orders, okay, which are on the buy side. And when they are on the buy side, you'll find, okay, suddenly, okay, that these people are buying deep into the market. Okay, let me just zoom out this chart. Please keep your questions coming in, and I'll try my best, okay, to answer all of them. So right here, you'll see now, okay, the market, okay, was getting a lot of initiative selling. Okay, this was a late seller which came in. The market, okay, went a little lower, okay, than the IS, okay, and after that, okay, the market has not made its lower, and now, okay, we have an initiative buying candle right over here, IB, right? Now what happens, okay, when there's an initiative buyer in the market, okay, you take a position above the high of the market with a stop loss of 25,010, and this 25,010 is still holding in the markets. This was an IB candle, okay, which came up over here, right? And this is holding, okay, for all these bars over here, and this IB candle is valid, okay, till we get another IS candle. So this was countered by some other market orders. The market is a free flow of demand and supply, right? So there are many institutions, okay, at work at one time, and just because, okay, we use this term called FII or DII does not mean, okay, that there is one entity in the market, right? At current count, okay, there are about 175 odd, okay, registered FIIs, maybe even more, and there are a lot more DIIs. Not everybody trades, okay, the same way, and not everybody, okay, carries the same bias. So sometimes, okay, we make the mistake, okay, of understanding FII intent as one person or one office or one entity. That's never the case. Okay, there are a lot of FIs, and sometimes, okay, they are trading against each other also. So every time, okay, you get an IB bar, okay, you have to, okay, watch out, okay, for an IS bar. An IS bar cancels an IB bar, right? And an IB bar cancels an IS bar, okay? And now that the market, okay, has got an IB bar, okay, we know, okay, that there is a chance, okay, that there could be another IB bar or an IS bar, okay, which can, okay, work, okay, with that market, okay, after this, right? So this is, okay, how it is shaping up right now. You can do this in a 30-minute chart. You can do it in a 3-minute chart. And in a 3-minute chart, okay, the signals are going to be much more, because, okay, you're working with 3-minute data. And what you do is that every time okay an IB forms, you buy above the high of the IB candle with a stop loss okay of about 25,050. Right now, the other thing okay over here is that you have to okay pay attention okay to the quantum of time involved in the trade. So when we say okay that you are working with a 3-minute chart, you have to okay work okay with the rule of 10 bars, right? The rule of 10 bars simply means okay that if you have a trade open because of a particular signal in a particular time frame, you have to hold okay that signal okay for the next 10 bars of that time frame. So a 3-minute signal is valid okay for about 3 into 10 bars, that is 30 minutes, and a 30-minute signal is valid for 30 into 10 bars, that is 300 minutes. That's about almost okay as one session. So something which happened on Monday, okay, and a signal okay came on Monday on a 30-minute chart is not valid okay till Friday. Now a lot of us okay as derivative traders okay, what we tend to think is that if we get a signal on a 3-minute time frame or a 5-minute time frame or even a 30-minute time frame, we tend to carry that signal and that concept okay for the next 3 days, 5 days, 7 days, 10 days. It does not have that kind of validity, right? Everything okay has got a time element to it, and it's got a certain amount of validity, right? Everything has got an expiry date, right? Everything okay, your food, your things okay which you have, your phone in your hand, everything has got a valid expiry date. And as traders okay, sometimes okay we tend to forget okay the quantum of time involved in the trade. So for us the rule is okay 10 bars. If a signal okay comes in a 3-minute, use it okay for the next 30 minutes. If at the end of 30 minutes a consistent similar signal comes, then hold on to that trade. If there is no signal coming in, the expiry date is gone and you have to wait okay for your next signal okay to come in. Right now, this is all about IB and IS. Okay, some questions are coming in with respect to COT. Now COT is the broader buying and selling of the market. It's not at all connected okay to market orders. COT okay will take into consideration limit orders also. Try to understand okay what I'm saying over here. IB, IS are market orders coming quick and fast in the market. Okay, COT is going to be the net of demand and supply in the market. What is a stronger signal? The stronger signal is your IB and IS signals. Okay, as a confirmation signal, you can look at that 10 bar COT to know if the market okay is demand side heavy or supply side heavy. Right now in this 10 bars, this is a 10 bar COT. You can see okay that the COT is marginal over here. But if I zoom in into a 30-minute time frame, okay, the COT is about 7,400 more on the demand side. Now every time the COT is green, or the 10 bar COT is in the region of about 7,400, 7,500, what is it telling me? It is telling me that there isn't a lot of supply in the market. The demand is slightly higher than the market by a factor of 7,500 contracts. Right? How did we arrive at this information? Let's not get into it. It's algo generated. Okay, it's part of the mechanisms. But what is important for you to know is that if the market is dropping on a 10 bar COT, if the market is dropping on a 10 bar COT, it is not a short. It is not a short, especially if it does not have IS signals. The market is going to jump back to a higher level very, very soon, because there is no supply in the market okay to take the market down. Because there is no supply in the market to take the market down. And if the market okay is going down on red 10 bar COT, that means there is enough supply okay to take the market down. All of last week, when the market was dropping, the COT was in the region of about minus 20,000, and it was very confident okay to hold. It was very confident thing for you to hold your shorts okay in that situation, because okay the market okay was showing you a lot of supply being greater than demand. Right? So try to okay understand okay the distinction over here. So what you do is, when this 10 bar COT is green, you zoom into your 3-minute chart. Now you have an IB signal. Okay, and now okay you can think okay about taking a long in this market. In fact, okay, it's about 25,060 right now. We have an IB signal, and with about a 25,050 stop loss, this market okay can okay move up to about 25,090, even 25,120 also. So we'll watch this okay how this goes along over here. The other thing, okay, which I just wanted to quickly, okay, point out to you, that this is not the only way, okay, you can see an order flow chart. You can, okay, see it, okay, in an options mode also. In fact, okay, we had this 51800p open, okay, from the morning today, and we were, okay, seeing, okay, a similar, okay, kind of a trade, okay, set up, okay, for ourselves, okay, in the options market also, right? So somewhere, okay, around here, the PE, okay, was showing us a lot of buying coming in right here around 437, 510, and we took this trade, okay, about 600, and then, okay, we got a move up to about 900, okay, based on over here. So the same principle you can apply, okay, to an options market also. You can apply it, okay, to a currency market. You can apply it to a commodities market. Okay, you can trade, okay, what you want with it, provided, okay, you know, okay, that your trading idea and your trading setup is there. The setup, okay, works in all markets over here. Right. The question is, okay, how many times, okay, you have to go in the money? I prefer, okay, to go in the money, because, okay, the decay is a lot more. Okay, so you can, okay, see if the market is trading, the futures are trading at about 51,600. Instead of going, okay, with a 51,600 and a 51,700, I'll go with a 51,800. Right? If the market is trading around 51,200, 300, instead of going with the 300 and a 400, I'll go with the 51,500. Try to give yourself, okay, the advantage of delta. Okay, that delta, okay, if it's the region of about 0.65, 0.75, you will maximize, okay, the move, okay, which is coming in from the market. Because what is happening is, you're not trading, okay, just about an average setup. You're trading with the benefit of big money being in the trade. Right? You're trading alongside big capitalized traders. So you got to give yourself every single chance of capitalizing, okay, on this trade, okay, which is about to unfold in front of you. So that's why, okay, go in the money, pay a little bit of premium, okay, but go, okay, for those better, higher qualified trades. Right? So I hope, okay, I've been able, okay, to communicate to you, okay, the importance, okay, of what order flow is, how you're going to be using data. Okay, and like I said, okay, data, if used correctly, it becomes knowledge. If it is not used at all correctly, okay, it is noise to a lot of people, and a lot of people, okay, do not make the effort of understanding data. But in 2024, we are going to be headed into 2025 very soon. There are a lot of regulatory changes happening. The world of derivative trading is going to be shaken up. You have to ask yourself a question. Do you want to trade alongside 95% of the people who lose money, or do you want to make an effort to understand how 10% of the traders are profitable? And if they are profitable, where are they entering their trades? And if they are entering their trades at a particular point, can I identify them? Can I trade with them? Right? They say knowledge is power. Right? But I like to, okay, take it one step further. If knowledge is power, what is lack of knowledge? What is lack of knowledge? Lack of knowledge is less power. And I'll take it one more step further. What is wrong knowledge then? Wrong knowledge is the result 90% of traders lose money to markets. Right? The evidence is there, okay, in front of you. We as a community, okay, have grown, okay, on order flow. There are a lot of traders, okay, who have worked, okay, with order flow. My doors are open. If you want to see, okay, how I trade, okay, how you want to see, okay, how trading can be done, we have an online forum for you. For those of you who want to meet me, okay, feel free, okay, to DM me. My doors are always open for you. Okay, if I can help you in some way, okay, to become a better trader, okay, I'm certainly able to do it for you. But beyond that, it's a battle, okay, with your mind. It's about, okay, how you understand your own self and how you understand the world of trading. You could be one of those traders, okay, who could be just about like anybody else, okay, thinking, okay, that this is not for you, and walk away, and you will never recover, okay, the money, okay, you have lost to markets. Or you'll make a decision today that, okay, I will learn how 10% of traders are making money today, and I will be with them. There's a saying in markets, if you cannot beat them, join them. So you have to, okay, join what 10% of traders are doing, what they are making, and the kind of efforts, okay, they are doing, okay, to become profitable. Right? So if this is making sense to you, okay, work, okay, with real data, work with the power of information, because this is something, okay, what majority of traders will not do. all right? And you have to put in real serious efforts to understand all that is coming to you. This is not your casual enter a trade, exit a trade, have a stop loss, move away. There is effort involved over here, and you have to really push in some effort to get going out over here. So put in those efforts, see how it helps you, and we'll see how this moves forward, right? So with this, guys, it's about 1:20. Just to close out, I just wanted to talk to you about what is happening in the market. So we'll go back to the Nifty, and right, the important thing over here is this is where we are trading right now, and we will have a blog post ready. So this is the big selling which has come in from last week, right, from 26,200 level. This is what we call an imbalance in the markets. Imbalance market is a market which was dominated by sellers, as we saw in the order flow data, and now we are putting in a balance. So this market has put in a balance. The market has moved from imbalance to balance, right? Somewhere if it goes back over here and meets sellers, we would be interested in shorting this market again. Make no doubt about it, the market is initiative dominated by sellers. The sellers have come, they are at an advantage, and they are driving this market. And the level in which their average holding is this level at 25,470. Anything which moves back up over here is going to meet a lot of selling going forward. And if, like I told you even on my Twitter, that 24,890 is the level on the lower side. If you see it coming lower, you should get an opportunity to go long over here, right? One final thought on that IB signal which came in as we were doing it, right? So I told you this would move up to about 25,090 based on this evidence. So the trade over here for you was to go long above this IB signal with a stop loss below the IB signal, and then you had an easy setup going for you. This does not mean that 10 out of 10 trades of yours are gonna go right, because like I told you this is data of demand and supply, and somebody big can come in anytime over here and drop the market down 1,000 points. So always be aware that these kind of things can happen. This is a market which works on current data, live data. Yesterday's newspaper is history. What you have to work on is current news, currently what is happening in the market, and that is the most important piece of news for you. What's in the past, let it be in the past. You have to work with what is happening right now. And as a derivative trader, you have to live in the moment, you have to live in the present, and you have to take it onwards from there, right? So with this, I'll call the session to a close. I hope you found this useful and informative. If you have any questions, please feel free to ask us. The recording of this is going to be on X, and yeah, we'll communicate further on that. Thank you for coming in. I'll see you later. Thank you, guys.